World Energy Outlook 2020, which started on Monday with the impact on COVID. Then we looked at electricity, then at all other fuels. And yesterday we had the net zero by 2050 case debate. So far, we had always very lively debates. So I'm very confident that today we have a very, very distinguished panel with us, and we have a very important topic. So my name is Mechthild Wörsdorfer. I'm the Director for Sustainability, Technology and Outlooks. And we are here with a team who is working on investments and finance in the clean energy transition, in the WEO and in the World Energy Investment Report, which we are coming up every year in addition in May. So for today, we will have first a debate or a presentation by our key analysts, Mike Waldron, who is the leading the investment team at the WEO, together with Lucila Aboleya, who is always also working on investments in the division of Tim Gould. And then we will have an excellent panel, and I'm really delighted to briefly introduce you to the panel right now. So we have Gu Yun Chung. He is the head of business development of the Asia Pacific region for Enel Green Power. This division of Enel is dedicated to the development and operation of renewables energy plants. So very much welcome, Gu Yun. Then we will have Deirdre Cooper. She's the co-portfolio manager for the Global Environment Strategy in the Natural Resources team and 91. This is an investment company based in London and South Africa. And as I saw in your CV, you're passionate about sustainable investments and finance. Last but not least, we have Dr. Nigel Jollens, who is the Associate Director at the European Bank for Reconstruction and Development, EBRD, who is based in London, and you're working as the Development and Energy Efficiency and Climate Change Department at the EBRD. So very, very much welcome for today's discussion. We will have the presentation first and then the discussion. If you want to participate, and I welcome everyone who is on our live stream today, if you have any questions on the debate to any of the panelists or my colleagues, I'm happy to take them. You can use the email address of weoweek@iea.org, or if you are joining in from YouTube, you can use the chat function at YouTube, and we can see the questions and I can direct them to the panelists. So we have then the session slides and the debate afterwards on our website. You can, by the way, find all the recording from this week on our website at iea.org. And now with this brief introduction, it's my pleasure to pass the floor to my IEA colleagues. I think we will start with Lucila and then go to Mike. Lucila, the floor is yours.
Thank you, Mechthild, and welcome everyone. Mike, yes, so we're gonna have the slide presentation. So going to the first slide, first a quick point in terms of scene setting. This year has been a special year for everyone. There's still a lot of uncertainty about the future. So the rate of growth of the global economy is more than ever a key assumption in our scenarios. So what you see on the left-hand side are three different GDP assumptions that we had. In yellow, the average GDP assumed by 2030, annual GDP in WEO 2019. So that is what we had last year. In blue, the underlying assumption of this year's WEO in the steps of the stated policy scenario. That is a scenario that reflects today's announced policy intentions. And in orange, the assumption of an additional case that we prepared this year, precisely to picture a case where things could get worse in terms of the virus and the economy, precisely because of the uncertainty. So very much, so in terms of steps, apologies, I just received a message. In terms of steps, we're assuming that the virus is under control in 2021, and in the case of the DRS, the delayed recovery scenario, it would be in 2023. This also has knock-on effects, of course, in energy demand, and that's what we see on the right-hand graph of the slide. Energy demand would be lower in both scenarios by 2030. In fact, pre-crisis levels would only be reached in 2023 in the case of STEPS, and it would take 2 more years in the case of the delayed recovery scenario. So what does the pandemic mean in terms of energy demand and investment? That's what we see on the next slide. Overall, energy demand is set to fall by around 5%, and with a big drop in all fuels except for renewables. That's the green and positive bit that you see on the slide, and a larger effect on emissions. We estimate that by the end of the year, emissions will drop by around 7%. But all in all, sort of the key takeaway is that investment is the most badly hit piece of the chain, and we anticipate a fall of around 18% in 2020. And so given that the investment drop is quite large, it is worth having a close look of what is happening in terms of investments across sectors. Impacts are set to happen across sectors, but the big story is in oil and gas supply. This is the sector with the largest cuts in capital spending, around 1/3 compared to 2019. As we saw at the beginning of the year, many national companies and international companies, as well as independents, underwent large capital spending cuts compared to what they had planned in 2019. So the impact on the power sector, on the other hand, is less dramatic. Within the power sector, there are differences, of course. Fossil fuel power is more affected because of lower electricity demand and a lower need for dispatchable power, while renewables, in particular utility scale renewables, are more resilient. So overall, for the power sector, we expect a drop of around 6% compared to 2019. So in relative terms, a sort of more positive picture, while still a warning sign given the current unexpected role of the electricity sector in the energy transition. So we anticipate a big drop in 2020. Hopefully that's clear by now, but still there are a lot of investment needs that have to take place. And this is what we see in the next slides. And in fact, the majority of these future investment needs of the next 10 years will need to happen in emerging markets and developing economies. The difficulty, though, is that the cost of capital has stayed the same or even lower in advanced economies in 2020 compared to 2019, while risks have increased in emerging markets and developing economies, increasing the overall cost of capital. And the numbers that you see on the right are indicative cost of capitals for some regions. So overall, low borrowing cost and availability of long-term finance is likely to continue, given the strong expansionary monetary policy, some of which was already happening before COVID, but it has been put in full motion very much because of the virus to stimulate economies across the world. This has helped lower government benchmark rates, especially in advanced economies, helping drive down the cost of capital. However, sovereign risks have risen in a number of emerging markets and developing countries. So we see growing risks challenging investments, particularly in the places where investment is most needed. And here's where governments will play a key role in terms of project bankability and reducing perceived risks that go, of course, also beyond energy. So a key takeaway of this slide is that the geographical allocation of future investment needs is very important. But as we see in the next slide, it is also important how it is allocated and how investment is allocated within the energy sector. So in this next slide, what we see is the global investment in energy supply, divided in two big buckets, fuel supply on one hand and power on the other hand. And as we see, our estimates for 2019 are around, that investment was around 1,600 in 2019, a bit more than half going to fuel supply, so 52%. And this compared to what we see in 2020, and you just saw, that's an illustration of that 18% going down to actually around 1,300. That's a drop that we saw in 2020, with also an interesting point that is that power actually became, the majority of investment went to power. And this is interesting because when we look at future investment needs, and this is what we see on the bars in the next below, so there, what you see is the average annual investment needs between 2025 and 2030 in the three scenarios. So to some extent, the sort of short to medium term investment needs annual in the three scenarios: the state policy scenario, the delayed recovery scenario, and the SDS, or the sustainable development scenario. I think we just missed the slides.
Go on the full screen.
Okay.
Thank you very much, Michael.
Thank you. So what we see there is the 2020 investment levels compared to the average investment needs. And as I was saying, the last scenario that we show below is the SDS, which is a scenario that shows a sustainable pathway, which is aligned with the Paris Agreement, but also incorporates other conditions such as improved air quality. And what we see here, I know it's a sort of a busy slide, but there are sort of two key takeaways. One is the need for increased levels of investment across the scenarios, but an additional point in the need for a reallocation of capital within the energy sector with a shift, with shifting more in the direction of power, especially in the sustainable development scenario. So all in all, governments and policymakers, again, play a key role in financing and or setting the right policy and regulatory frameworks to enable these increased investments and to set the right incentives to shift more capital towards power. But of course, because of the slide I mentioned before about also the need for reallocation within geographies of the world, the role of the donor community and developed countries will also be needed to help the reallocation within geographies. And with that, I pass it on to Mike.
Okay, thank you very much, Lucilla. In the second half of the presentation, we're going to focus a bit more on the investments needed for clean energy transitions, as well as some of the government and financial actions to get there. Now, as governments consider ways to mobilize capital in line with clean energy transitions, they're going to need to consider several big investment issues. The first of this is that clean energy sectors across the board will need a boost in spending to meet sustainable development goals. More than 3/4 of the average annual $3 trillion of investment that's required in 2030 in the sustainable development scenario goes to clean energy and electricity networks. And the share of clean energy in total investment needs to rise to around 2/3 by 2030. And this is occurring in a number of different sectors. And what we've done here is we've shown you a bit of a snapshot of progress or trends in different sectors. Of course, there would need to be a strong increase in investment in clean power. This is illustrated by a doubling of spending in renewable power, but also a strong increase in nuclear. There would need to be increases in investment in enabling infrastructure. We'll talk about grids in a bit more detail in a couple of slides, but on this slide, you see a very strong trend, which is needed in the scale up of battery storage investment. But it's also looking at investments in the demand side and in sectors around transport and heat and other difficult to decarbonize areas. So for example, in the electrification of end use, you would see a dramatic shift towards electric vehicles under the SDS. Around 40% of passenger car sales by 2030 would be in electric vehicles. And you'd see an acceleration compared to what we had in 2019. This would all be underpinned by an increase in energy efficiency. So we show this on the right as energy productivity. So essentially the inverse of energy intensity. It means that we're able to achieve more economic output with the same amount of energy. And what this would involve in terms of investments would be a range of applications and assets, ranging from building retrofits to new appliances to more efficient vehicle drivetrains and conventional vehicles. But it's also important to remember that improving energy efficiency is not just about investments. As we saw yesterday during the presentation on the net zero case, there's a lot of very interesting analysis in the WEO this year on how behavioral changes, particularly in light of the current pandemic, can also be very important and also a very low cost way of saving energy. Finally, we'll also need to see a dramatic scale up in investment around low carbon fuels, including biofuels, biogases, hydrogen, carbon capture, and as well in sectors which are very difficult to decarbonize. So thinking about investments in heavy industry and freight. Now, when we're looking at how governments are going to do this, and we're thinking about the types of policies that would incentivize investment in the allocation of capital, one thing we looked at this year was the interaction of risks, returns, and the cost of capital. So we did a bit of a deep dive in the utility scale solar PV sector, and we looked at revenue risks for solar PV projects and the implications for the cost of capital. Stepping back a bit, we see that over 95% of investments in the power sector in general are reliant on cash flows that are somehow tied to regulated rates of return or long-term contracts. So having this price and volume and revenue certainty is very important for investments and lowering the cost of capital. And what we've seen in recent years in utility scale solar PV is that a combination of strong policy support plus improved maturity of the technology have helped to mitigate risks, perceived risks for developers and financiers, and this has helped to reduce the weighted average cost of capital. This has been aided and enabled by a very low interest rate environment and advanced economies, but it's also due to lower base rates we're seeing in other places around the world, such as China and India, which has reduced debt costs. As a result, and you see this in the graph right here, utility scale solar PV, if we're looking at these ranges of cost of capital that we put in the WEO, is now consistently cheaper than new gas or coal-fired power plants in many places around the world. This is enabled very much by the revenue support mechanisms, however. So there are questions in some markets about how these will develop and evolve, whether there will be more exposure to a higher degree of merchant pricing for some projects in competitive markets. There's also the question about how cost of capital in general will evolve. So Lucilla has pointed out that risk premia in several markets have gone up in 2020. And it's also still the case that financing costs for solar PV are some of the largest components of the overall cost of generation when we're looking at emerging economies, where there's still a number of residual risks to address. Now, it's not just looking at cost of capital and reducing risks for renewables, but it's also another priority sector for investment that we noted in this year's World Energy Outlook is in system flexibility. So all flexibility sources are needed in the clean energy transition. But here we're really going to focus on one key aspect of power infrastructure, and this is electricity grids. Millions of kilometers of electricity lines and other network infrastructure support electricity transformations around the world. And this is done by helping to integrate the rapid growth of variable renewables, but also expanding grids to serve access to new consumers who are being electrified by the grid. When we're looking in the stated policy scenario and we're looking at the investments required under here, we see an increase of 80% over the next decade compared to what we've seen over the past decade. So we're near doubling. And these investments go towards not just new lines, which is shown in the yellow part of the graph, but they also go towards the replacement and the upgrading of existing lines, which is a particular investment challenge in legacy systems. They go towards the digitalization and the sort of making electricity systems smarter through smart meters, smart distribution infrastructure. And they also go towards integrating new technologies, such as electric vehicles, as shown by the orange part with the investment in public EV chargers. Now, there's a risk which is emerging in 2020, and this is because the revenues for grid operators and utilities have suffered during the pandemic. And this raises a risk for timely investment. We've seen some of the largest power systems in the world, seen significant reductions in their revenues in the first half of 2020. This is causing delays or inadequate investment. Electricity grid investment is one of the sectors that's declining by more than renewable power, if you would have seen on the earlier graph. And also there's longer standing issues in terms of getting networks investment. This has to deal with basic issues related to land and permitting, but it also deals to more complex issues regarding regulatory reform in certain markets to enable the financial sustainability of the utilities who are developing the power projects. And so grids are really kind of a keystone of the energy transition. And if they do not expand as fast as renewables and other low carbon sources, they could possibly be a bottleneck for that transition. Now, the last two slides are going to deal more with kind of financial issues. And when we're thinking about investment progress in all the areas that we've highlighted during this presentation, a lot of this progress is going to hinge on better linking the sources of finance with the areas of greatest need and aligning these sources with the requirements of companies, consumers, and assets. And on this slide, we're looking at this in two dimensions. First, we're looking at the role of public versus private sources of finance through the ownership of new investments. And this slide is really focused on the clean energy related sectors in the sustainable development scenario over the next decade. So clean energy plus electricity grids. What we find is that over 70% of investment would need to come from private sources under clean energy transitions. This should come as no surprise. It's private developers who lead the way in developing renewables, efficiency, new technologies in a number of markets around the world. But also you can see from the sort of green bars here that state-owned enterprises still play an important role. They play a particularly important role in large-scale hydropower developments and nuclear developments. They play the majority role actually in the ownership of electricity networks. And this is particularly true in emerging market and developing economies where they serve as the off-takers, so their performance has a big influence on the power projects hooking up to the grid, but they also serve as the main investors in the grid themselves. On the demand side, it's a bit less in terms of the public ownership, but it's also noted that public ownership of buildings can actually be a very important way to tackle low-hanging fruit for efficiency. And looking at the industry sector, state-owned enterprises still play a pretty important role, particularly in countries like China, where they underpin a good portion of heavy industry. So both public and private will be important, even though private is expected to lead the way in terms of investments. The other dimension that we looked at in terms of sources of finance was the role of different financial instruments. And so even though private sources are going to lead the way, it's not necessarily all going to come, all the money is not necessarily going to come from the balance sheets of the private developers. There's a certain amount of diversification which is required to meet clean energy transitions. And this has to do with crowding in more secondary sources of finance, including from banks and institutional investors. But there can often be sectoral lending limits for banks in certain places. Capital markets remain underdeveloped in a number of places around the world, which can challenge institutional investors. So for these reasons, we thought it'd be very interesting to look at the capital structure of the investments needed under the SDS, so the amount of debt and equity. What we find is that under the sustainable development scenario, the capital structure shifts a bit to a somewhat higher reliance on debt. It's about 50-50, but under the sustainable policy scenario, we would see typically more equity than debt because of the higher role of fuel supply. So debt leverage plays a bigger role in large-scale power projects, but it also plays a bigger role when you start to integrate some of the demand-side infrastructure and technologies. So project finance deals based on renewables are typically highly leveraged, but also looking at things like the financing of commercial buildings, mortgages and automobile loans, which are more developed in advanced economies than emerging economies. But that's in the low interest environment actually creates a nice opportunity to raise debt at very low costs. But of course, it won't be debt which carries all the energy transition. Equity, which is a risk-taking form of capital, will be very important, and particularly important in sectors like industry, which is much more reliant on equity. Now, when we're looking at where the money will come from, one cross-cutting issue that we looked at was the role of sustainable finance, the role of sustainable finance initiatives, the role of debt issuance in sustainable finance, and this sort of interaction between the financial system and the energy system. And what we found is that there's a rising number of sustainable finance initiatives and taxonomies around the world. We see that sustainable finance investments in the portfolios of investors, some evidence that they can deliver better risk-adjusted returns for investors than fossil fuel-based investments. And we've also seen that the ability of developers to standardize their investments and assets has resulted in a very strong, dramatic growth in sustainable debt markets and green bonds issuance. This is, of course, coupled with the framework for labeling and certification that goes around that as well. But despite this strong growth, and we have seen it hold up in 2020. Actually, the 2020 number reflects January through August, so it's a bit more resilient in reality than it looks on the chart. But amid all this growth in sustainable finance, we've seen the overall trend for capital expenditures for clean energy be flat in recent years. And of course, as we've highlighted before, it's declining in 2020. So the question is how to better connect the financial flows to the real energy economy. And there are some ways to improve the situation. One has to deal with creating more bankable energy projects. And this has to deal with aligning the energy policies in a way which supports bankable project development, but also does it in a way which is aligned with the financial sector development and the sustainable finance initiatives development. Another issue relates to the fragmentation of some of these sustainable finance initiatives in terms of the standards and definitions being used and accounting standards being used in different parts of the world. And also it's important to remember that a lot of sustainable finance would concern listed companies, whereas there's still a very big role for unlisted companies and state-owned enterprises in the energy transition. Lastly, there are questions about how green bonds, green instruments can support more complex transitions. So thinking about the funding needs of energy intensive industry or fossil fuel sectors, activities which are important for emissions reductions, but may not be strictly dark green in terms of labeling. This is why the current discussion around transition finance is becoming much more important and is also reflected in the chart on the left with some of these performance-based instruments, which are in blue, which better try to tie, for example, cost of capital to emissions reductions or energy use reductions. So with that, I will conclude, and I will very briefly wrap up, noting that the COVID-19 pandemic has set in motion the largest global energy investment drop in history, with spending declining across every major sector. We've highlighted this notion of the growing mismatch between investment needs and financing conditions, in particular in emerging market and developing economies, of which we're planning to focus a lot of our work on next year in terms of understanding how to finance clean energy transitions in emerging market and developing countries with a special report we're planning to produce. We've highlighted that electricity grids remain critical nodes in clean energy transition, but the current conditions or progress in electricity grids is raising a warning sign for future investments. And this is also clean energy transitions are dependent on mobilizing much higher levels of private capital into renewables, efficiency, and other low carbon technologies. Policy design is going to be very important for this, but also a limited amount of public finance. And the solutions and the approach is going to be holistic with no shortcuts, and policymakers, citizens, and investors will have to focus more on resolving structural issues, which is a challenge, but also could be a very good opportunity during the current pandemic. So with that, I will conclude the presentation and I will hand it back over to Mechthild for the moderation.
Thank you very much, both to Mike and Lucila. I think you saw how strong the impact was from COVID on investments, and I will now open the floor to all of you, and I will start with Guyun. As I said in the beginning, you work for the Enel Green Power Group as head of business development. You're based in Singapore, so special thanks to spend your evening with us. As we heard, the pandemic has hit demand rather strongly, and we expect also some lasting effects beyond 2020, beyond this year. How is this impacting your investment decisions as a developer? And where do you see, which are the sectors and markets which are better positioned and which are the ones which are in a less good position? The floor is yours, Guyun.
Thank you. Can you hear me, Mechthild?
Yes, very well.
Well, first of all, thank you for having me, and it's a great pleasure to be here among esteemed speakers and panelists. Being a developer, I guess I have to speak as an eternal optimist. But I would say that the impact of COVID on power consumption has actually been less than its impact on GDP. And we see this borne out in many studies. And I would say in the Asia Pacific market that I'm in, I see this trend. So for example, in OECD countries that we are operating, for example, in Australia, we've seen that the drop in industrial consumption has been somewhat compensated by the spike in residential consumption. I mean, the panelists before starting, we were joking about Netflix, but I mean, I think everybody can relate to the fact that there's been an increase in residential consumption. And in Korea, for example, there was actually a slight rise last summer compared to the year previous, solely because there was an unusual heat wave and a lot of people were using their air conditioning. And then, if you go to emerging markets, like for example, Vietnam or India, I mean, still the economies are going strong, and the demand has not been reduced. So I would say that all in all, I would say it has had an impact, but I would say it's not as big as impact, say, in other sectors. Now, the impact on the growth of renewables, I would say, is even less. And I would even venture far enough to say it's been almost negligible, at least in the markets that I'm operating in. So in all of the markets that I'm in, and most of the markets that Enel Green Power, frankly, has seen growth across in all of these markets. And I think the IRA report that came out just a few days ago on renewables actually bears this out. I believe there was an update on the report that was made in May. And I think even there it shows that the impact on renewables growth has been less severe than has been expected. Obviously, now with the new COVID wave, I guess it remains to be seen what permanent impacts there will be. But so far, I would say the growth of renewables has been quite constant. And I would also say that there's a saying that governments should never let good crises go to waste. And we've seen that many governments have been using their economy stimulus programs to target policies on clean energy transition. And of course, the EU level Green New Deal is a prime example. And there's been some emulation. So for example, Korea has introduced their own version of the Green New Deal. And we've also seen Japan and China announce carbon neutral targets. So there's been a lot of government support, I would say, in this direction that has actually helped. So I wouldn't say that's linked to the COVID, but it is a strong government signal that we're seeing. Now, this is not to say that there aren't risks. Obviously, there are risks, but I would say these risks are more tied to the actual nature of the business than it is to COVID. And in some ways, these risks are tied to the fact that maybe the renewables industry has become a little bit a victim of its own success. And I say this because we've seen a tremendous growth, for example, in India or in places like Vietnam, where there's a lot of new market entrants, some of them, say, more aggressive than others. And this obviously creates some growing pains. And we've seen some tenders not leading 100% to projects being executed. But all in all, I think these competitive pressures have been, in general, been good for the industry. There are also, because of this additional penetration of renewables, there has been this perceived or real strain on grid infrastructure. And we're seeing that, at least in all of the markets that I'm in, the governments are trying to grapple with how they can provide this additional flexibility to allow these variable renewable generations to be harmonized into the generation fleet. And other risks, I would say, are tied to things actual to project development, such as contracting land and things related to finding, as was mentioned by Mike and Lucila, tied to financing. I would say the biggest winner in terms of sectors, I would say, is basically ones that are tied to electrification. And we're seeing that electrification, if not already, is increasingly becoming the most efficient or the cleanest mode, not only for the traditional uses of electricity in residential, industrial uses, but also in heating and cooling, and now more interestingly into transport. And one interesting thing is, even during the pandemic, when the vehicle sales of internal combustion engines have been tanking in all markets, we've seen in most, if not all, the markets the sale of electric vehicles to rise. So I think that those sectors that are tied to the electrification of energy use will be the clean winners of the sector.
you very much, Guyun, and thank you very much also for sharing some optimism. I think in this time of COVID, it's good. And I think from the IEA side, we can certainly agree on the resilience of renewables. You mentioned our recent report where we came out with the figures for the near term, and also, as you say, for electricity in general. So thank you very much. Let me turn to our next panelist, Bertre, if I pronounce that well. Very much welcome. You are a portfolio manager, as I said in the beginning. And what are your thoughts? Could sustainable finance initiative represent a game changer for clean energy investment? And how could these initiatives better respond to the capital needs of companies and of countries, and how to stimulate real spending on projects? What we heard, that is the missing part. So please, if you can elaborate on that, Bertre, the floor is yours.
Thank you so much, and such a pleasure, to speak to you all this afternoon. Look, I think our industry, has a hugely important role, as you point out, in allocating capital. We've all seen analysis by you and others, that suggest that if we want to move to a 2-degree scenario, we need somewhere between 2 and 4 trillion, increasingly at the top end of that range, right? Because the longer we wait, the bigger the required amount of annual investment will be to finance the transition. And as Michael pointed out, a large amount of that is not coming from governments. It has to come, from the market. Where we are today is we're investing about 500 to 600 billion. So, it's less than a quarter of the amount of climate finance that's required. So we think investors have a huge responsibility to allocate to and to engage with companies to encourage them to reallocate capital towards a 2-degree scenario, which as you've illustrated in some of your charts, is going to require a huge change in where investment is going today. I think in our view, there's probably been too much investor, as we think about our own industry, I think there's been too much investor focus on divestment and not enough focus on positive investment, which is really the huge challenge and where we're going to make an impact. I think there simply aren't enough strategies and investment allocations that are really focused on the opportunity. And actually, that's also just a shame for all of us as the ultimate pension fund holders. It's all our money that's being invested because we really believe that over the long term, those companies are exposed to a much better growth outlook, you've talked about, and therefore those companies should outperform over the long term. So this is a really interesting area where in helping to allocate capital to solve this problem, we can also generate better returns for all of our pension funds. How do we go about that as investors? We think it's really important to keep engaging on long-term science-based targets. We really want to see more companies do that, especially for those harder to decarbonize areas. I think this is a great tool, to monitor management teams. And then, of course, you need to look at those targets. It's super easy to put in place a 2050 net zero target. And there's hundreds of companies that have done that, but there's only a handful that have clear, measurable, intermediate targets so that we can monitor the progress in getting there. And that's vital. If it's just a 2050 target with nothing behind it, then it really is just greenwashing. Having said that, it's also important to take into account nuances and regional differences. I think about 3/4 of the required investment that I talked about needs to go in emerging markets. But clearly, when you think about listed equities, the data disclosure is much weaker in emerging markets. We also need to be careful, Michael, you touched on sustainability regulations. As sustainability regulation comes into place, I think we have to be careful about over-reliance on data. If we do our ESG by numbers, that may mean under allocating to some of those places. That's really close to our heart at 91 because we're a firm that was born in Africa. So, we think you have to have some patience. You don't want to risk defunding those emerging market companies where disclosure is currently weak, but energy demand and the need for climate finance is huge. To take an example, last year, I think 9% of Chinese A-share listed companies reported emissions versus 66% of MSCI equity. So the engagement effort, we need to make sure that we think not just about developed markets, but also emerging markets, and that we as investors, which is our job, remain comfortable with imperfect data while we engage for better disclosure and help to fund those regions where the impact will be the greatest. So we think regulation and transparency are hugely important, but don't rely on ESG by numbers. You really need to understand the context as well.
Thank you very much, Deirdre. I think we at the IEA, we are looking at some of these issues, and as it was already mentioned, not only the companies, but more and more governments, China, Japan, Korea, others, EU, UK since longer, have come up with their net zero pledges. We are looking in more detail what is behind it from an energy policy point of view. And I would agree that it's easier to set a target than to implement it. So this is the important phase right now. So let me now go to Nigel Jollens. You're well known to the IEA. You have spent a few years at the IEA in Paris many years ago. Let me ask you also a question. We heard in the presentation that access to finance may be under pressure in a number of our emerging and developing countries. There's also a lack of bankable projects in key clean energy-related sectors. What is your view as a public finance provider like the EBRD? How can we help risk mitigation and facilitate developer capital at scale? That's what we needed, but how can we do it? Nigel, the floor is yours.
Thank you, Mathilde, and thanks to IEA colleagues. Fantastic. Again, the analysis that comes out with the work you're doing on the WEO is always so groundbreaking, and particularly the focus on investment. Look, let's talk about this perfect storm, or in the context, I happened to be in Sudan earlier in the year, and they have these sandstorms. They call them haboob, and I think we're in the context of a perfect haboob here. On the one hand, we have this restriction on the flow of finance. We've got deteriorating currencies, we've got commodity prices and export earnings, tourism revenues all dropping through the floor. So supply of finance is very tight. And on the same time, we've got this huge demand for investment to ensure that any recovery that we do is going to be green. And we've seen through the presentation that Mike and Lucilla gave, this something like 14 trillion in energy investment needs between now and 2030. And a big chunk of that's going to be in the clean energy sector, right? So going forward, we've got this constriction of investment, and we've got the growing need in the clean energy space. And I think you pointed out the bankability, and there's also the risk, and we've heard risk from a couple of the other panelists. In terms of what institutions like EBRD can do, I think public institutions like EBRD are critical on two fronts, one on the bankability and the other one on the risk. First of all, in terms of bankability, we play a key role in lubricating projects and the process to make projects bankable. I don't just mean providing access to finance. Mike mentioned the importance of policy. And in fact, EBRD, we do a lot of policy dialogue to change the market framework conditions within which clean energy projects exist and are developed. For example, in the Western Balkans, we have a credit line facility there on energy efficiency in buildings, 370 odd million euros of investment. And we combine that with policy activities to change the way that the market operates. So, for example, we've been transposing the energy performance of buildings directive into legislation and regulations in the Western Balkans. And we've been doing this sort of policy stuff since 2009 or thereabouts. I think we've done maybe nearly 500 policy assignments costing probably over 100 million euros of donor money invested into the policy element. So policy is one area where I think we need to assist with ensuring that projects are bankable. The second one is through technical assistance. So it's no point just going into a place, particularly in the countries where we work, and going around knocking on clients' doors saying, hey, can we do some energy efficiency or some renewable energy projects with you? They'll look at us with glazed eyes and won't have any idea what we're talking about. We need to be able to build their capacity and understanding of the opportunities that are there. For example, we have a resource efficiency audit framework where there's like 25 million euros available to support clients going through the process of identifying, recommending, and designing resource efficiency, energy efficiency, renewable type projects. I think we've done probably close to 600 audits for clients over the last few years. So, so that's about the bankability. It's not just about making access to finance, it's policy and technical support as well. On the risk front, you know, improving the laws and regulations, they can help to an extent to reduce policy risk, but there's also managing the financial risk. And from my perspective, we had this really interesting intervention at a webinar hosted by the EBRD last week, where we were releasing our transition report, and Professor Mazzucato from the UCL made an interesting comment. She said it's important to not talk about de-risking and removing risk, because the risk is always there. It's about managing and sharing risk effectively. And so the institutions like EBRD, we work closely with the donor community to establish these kind of risk instruments. And a good example of that is the European Fund for Sustainable Development, launched in 2018, and it's signed about 1.5 billion euros of guarantee allocations, supporting close to 20 billion euros of investment. And I think that's going to morph into a thing called Invest EU guarantee, which is going to be another element of this kind of risk management stuff. I think also we, as an institution, as a public finance institution, can help manage, can help share risk by blending our capital with concessional finance from donors. You know, this is to reduce market failures and address things like externalities, and affordability constraints. So if we bring all of this together, the policy, the technical elements, and the risk mitigation, at the bank, at EBRD, we've done something in the order of 36 billion euros of investment since 2006 in this kind of green space. And surprisingly, one of the largest chunks of that has been in energy efficiency. You know, this is the one that's sort of tagged to be the most difficult area of investment. But it's because we've been able to combine these elements that we've been able to do investments in clean energy across these kind of very dispersed client base. Thank you, Matilda.
Thank you very much, Nigel. Also to underline a little bit the policy link EBRD is doing, the technical assistance needed, and in the regions you're playing a key role. So we have now had a first set of questions. I see that more and more questions are coming in, so I thank very much the audience to be so active. I can already reply to one question. We will put the slides online. So the slides from Lucila and Michael will be online after the session together with a live stream. But maybe I can pick up one or two questions we got. And one I think is more for Guyun, if you allow. So we heard also in the presentation that it's important not only to invest in renewables, but also in grid infrastructure and some flexibility resources, battery storage, and all that. How do you think the business model differ in these areas compared with the regulated markets? That's a question we just got, and I think you're well placed.
Sure, Matilda. It's an excellent question. So regarding batteries, I think for using the grid for helping the flexibility of the grid to allow more renewable penetration, I think there's two ways to look at it. So on the supply side, integrating batteries into, say, renewable projects is a must. And so for us at Enel Green Power, we are integrating or considering to integrate batteries with all of our solar, wind, even hydro and geothermal from the very beginning. So that's step one. So if we don't do it, we should have a good reason why we're not doing it, because there are obvious reasons in having that value of being able to firm your capacity to do the balancing. There's so many benefits that happens from the generator side, but also from the grid operator that gives them a lot more flexibility. And different markets are incentivizing and supporting this in different ways. So, for example, in Korea, they give what they call a multiplier on the RECs that are given for load shifting of batteries. So it gives enough incentives so that the batteries allow those renewable energy plants to maximize the use of the substations of the high voltage grid. In Australia, there's a very active ancillary services market that provides another revenue stream for batteries that are integrated with generation. For example, in India, they're now announcing very innovative hybrid tenders. So basically, they give the freedom of the developers to propose their own configuration of adding solar, wind, and batteries in a configuration that will best reflect a generation profile that meets with the demand. So these things are happening, and so I think from a policy standpoint, I think Nigel made a very good, very important point about the importance of policy, and I do appreciate how the DFIs are really helping with governments on introducing the right policies. I think these are all examples of good policies that incentivize some of these technologies to take off, particularly if they're not yet economic. And batteries are almost there, if not already there. Then on the demand side, as you know, there's been a shift in the conventional thinking in the industry where only up to maybe 5-10 years ago, it was always about supply trying to match demand, right? So that you have the synchronous match between power supply and demand. And now it's switching. So now we're finding ways, because the grid is becoming smart, that was mentioned by Mike, we're finding ways for the demand to be able to meet, to be flexible enough to sometimes meet the supply. So, demand response, behind the meter applications for, using batteries or even rooftop solar, and even using some advanced EV charging technology so that we have vehicle to grid services, all the things that, Enel is doing through a different business position. So all this means that on the demand side, by definition, you are creating a marketplace with very different players that are sometimes asset light, but basically smaller players that are completely changing the ecosystem. And what's important here is that we understand that this market is fundamentally different from the industry that we're used to, which was centralized power stations and very fixed assets. This is a much more nimble marketplace that we are also very interested in participating, but we also welcome these different kinds of players. And it's important that the government makes sure that these markets can thrive and that they can function well, so that there's a good market, policy, market design, and that allows for price discovery, that can really send the right price signals for certain services. For example, demand response is probably the cheapest way for us to be matching, supply and demand. So I think those are kinds of the things that we need to think about in terms of how we can more effectively and efficiently use the grid.
Thank you very much, Guyun. I think there's a question which fits quite well, and I saw Nigel nodding quite a lot to Guyun. But I think you mentioned it already, it's about the bankability of energy efficiency projects, because they are by nature a lot of projects, but smaller scale. So how can we, you as a bank, encourage this kind of finance at a larger scale, be quite different projects in the energy efficiency? Very shortly, please.
Sure, thanks, Mathilde. Look, the short answer to this is EBRD and public institutions like ours are big banks. To get down to small small businesses, we've got to use intermediary financial institutions. So we've got a very effective credit line facility, and we're not the only ones. I know KfW, World Bank, others are also doing this, where we lend to an intermediary bank, a local financial institution with certain criteria on the use of proceeds, and they on-lend to their customers. And we've done this since 2006. There's 6.5 billion euros of loans have gone out for mainly energy efficiency. Those loans have been on-lent through the local banks to about 130 to 150,000 clients. There's no way we could do that. We don't have the relationship with the clients. But the important thing is that those kind of instruments are going to be completely useless if they're operating in a market that does not have the right market framework conditions by way of policy.
Thank you very much, Nigel. I have one question which is in another area, and I hope Beatrice can react to it, which are the sectors which we are calling hard to abate sector or difficult to decarbonize. So that is heavy industry, it's freight, it's aviation, it's shipping. What kind of signals policymakers can provide in order to better mobilize capitals to be invested in these kind of hard to abate, hard to decarbonize sectors? Maybe you can very shortly give us some insight.
Yeah, I think a lot of it would be visibility. So I think for those sectors, companies have to make very early investments where, unlike what Enel, for example, are doing in the power sector, it's very easy to see how that's going to translate into shareholder returns. If you're in one of those harder to abate sectors, if you're an airline, spending money, or an airplane manufacturer on, technology that you will need for sure to survive in 20 years, the more visibility government gives you on exactly what that roadmap is, the easier it is to make those investments, I think, and explain them to your shareholders.
Thank you very much. I fully agree to that. We have 3 minutes left. So thank you for all the questions which are coming in, and we will make sure we reply to them. But we have to conclude the panel right now, and I think it was a really very interesting debate. I have one 1 minute, one sentence question to the three panelists, because as Mike mentioned, one of our key projects for next year is to look at investments in clean energy transitions in emerging markets and developing economies. We are doing a WEO special report on that. What would be the one top advice for the IEA, for the team, on that specific topic on emerging markets? Maybe I start with Beatrice.
Well, maybe I can give a piece of just general advice, which will be relevant on that topic, but I think is hugely important, which I've discussed with the team many times. But I would certainly argue that the cost of capital that the IEA uses for renewables is realistic. So you're using a 7-8% cost of capital for solar. In Europe, that's probably 3 times too high. It's not even off by a percentage. And you're using the same across technologies, which again, once you look at grids and contracted assets, that's absolutely not the same risk profile as an asset that has input price volatility. And I think if you take that learning to emerging markets where clearly, you still have interest rates, which is not something that we have in Europe, then that learning is going to be really important. You have to differentiate between the different kinds of assets. And I think that's probably the biggest, in my view, along with questions on technology roadmap, which I know have been raised on the chat. That is one of the things that I think, is including those adjustments would be hugely valuable in the IEA's work going forward.
Thank you very much. I turn to Guyun, please. One piece of advice.
So I would say policy design in the sense that the government should set very clear long-term goals, like renewable goals or carbon net zero goals, which provides a very broad direction, and then make sure that we create the marketplace and clear rules. But it doesn't mean the government has to directly intervene, but creating that marketplace that allows price discovery, I think, is very important. And there's a lot of good examples around the world that I think the IEA can take and really share those best practices around the world.
Thank you. Nigel, last but not least.
Yeah, snap with Guyun on that one. I would say to the IEA, don't forget that investment in clean tech, clean energy is part of a business ecosystem. You can't just look at that investment on its own. It's got to be seen to be part of the policy work, the technical capacity. And when you're looking at this analysis, please, I think I would plead that you look also to identify what the investment grade policy requirements are, so that you don't just say, okay, this is the amount of capital that's needed, this is the kind of projection, but these are the policies that are needed to enable that to happen. That's a key role, I think, for the IEA. Thank you.
Thank you very much. And now it's exactly 3 o'clock, so we need to stop and finalize this discussion. It's the last session also in the WEO week. So I would like, first of all, to thank the panelists today. I would like to give a big thank to the investment team and Michael and Lucila here and Tim Gould, who is heading it as the WEO co-author together with Laura. We had a fantastic discussion today. I really learned a lot. So I think we had a few thousand viewers. And if I can share one figure of the week, we had in the 5 WEO week webinars more than 20,000 viewers over LinkedIn, Twitter, our own website. So I would like to thank everyone who is watching us, including also obviously our own communication team and everyone who was involved in setting that up. It is a new initiative which we did this week. I mean, I think it was very successful. So thank you very much for you today. We will continue, as we mentioned, our investment work and have a special report next year on emerging markets. We learned from you and we learned from the questions, and we will come back to all of you soon. So thank you for now. I close the